Thank you very much. Good speaking with you. Appreciate you joining in with some of that perspective. Thank you. 300 points on the Nifty. By the way, the small cap index has picked up a little bit. It's got a 0.5% odd gain. Now nowhere close to where it was earlier on. Mid caps are more flatter. But none of it, of course, rubbing off on what the Nifty is doing, which continues very strongly. Rahul Baijal is Senior Fund Manager, Equity at HDFC Asset Management Company. Rahul, great to have you with us here. Rahul runs the HDFC Top 100 Fund. And I think there is a new sort of fund which is coming on as well, and we'll talk about that. Rahul, but what are your thoughts on the market at this point in time? We have had pretty significant price moves last night on the back of softer inflation data, which was the crux of the problem in the first place. Does that take away? I mean, the market here has been doing well, even despite that. We were already at almost new highs. Does it give added impetus or not really? What's your sense?
Yeah, thanks, Prashant. So I think, the market has been in a corrective phase for almost more than a year now. And it's locally and globally, and even other asset classes. I think after this corrective phase, there were two key macro indicators which the market was focusing on. One was to get some direction on the inflation peaking, the timing of that, and when would one start looking at a rate cut outlook beginning. And two is the extent of the slowdown that may come in the West. So I think on the first front, you got some clarity yesterday. It looks like that there is some visibility on the inflation peaking, and therefore some visibility on the Fed pivot happening. And I think that's why you've seen some sort of a risk on emerging on the first front. I think on the second front, there is still more clarity, which will come with time. But clearly, after yesterday, one leg of the risk off seems to have some sort of a risk on coming in.
All right, Rahul. Always a pleasure speaking with you. Let's talk about the new fund offer that you have right now. It's called a business cycle fund, where you will obviously look at companies which are more favorable where there are benefits of this cyclicality, so to say, and avoid companies which will obviously are looking at a down cycle when it comes to business. In your experience, currently where the world is poised, what do you think are the spaces where the business cycle is more favorable, and which are the ones that you would avoid?
Sure. So I think if I look at India, there are a lot of business cycles in favor, and more local cycles than linked to the export market, where the risk of growth slowdown is ahead. And within India, if I look at the multiple business cycles which are looking good, clearly banking is one area where we're seeing growth picking up. Asset quality issues are behind, and they're well capitalized, and you can see it in the quarterly results coming out as well. So banking is in a multi-year upcycle. Secondly, the private sector capex cycle, which had a long downturn till 2020-21, is seeing signs of pickup across various sectors, and we're getting good feedback on brownfield capex picking up from the banks, from the various companies we talk to. So clearly, early stage of a multi-year upturn over there. Thirdly, the real estate cycle. Again, India had a long slowdown, almost a 7-year slowdown from 13 to 20. And during COVID times and the last 1.5 years, we are seeing clearly consumers coming back in the top 10, 15 cities, and even in deeper India in terms of purchasing flats for consumption. So I think that's an area which is picking up. And then there are secular upcycles, which have been going on for some time. Specialty chemicals, I think with China plus one, still you have headroom for the next 5-7 years to grow. So clearly, these are 4 areas where I see strong upcycles. And then there are pockets in the smaller segments like hotels and hospitals, which also offer potential for upcycles to continue.
Rahul, afternoon. At what stage of the upcycle are we in all these identified areas of opportunity for you, whether it's real estate, private cycle? Because markets have done well. All the sectors identified by you have done very well. We are pretty much at all-time high levels. Valuations in many of them are very excessive. So, fair enough. These are all cyclical businesses and they're doing well. Just wanted to understand at what stage are we in currently for each of them?
Sure. So if you look at typically duration of business upcycles, the range varies anywhere between from 3 to 5 years. Sometimes they are shorter as well, as less as 1 or 2 years. So it's an entire gamut of duration which you get to play when you're playing business cycles. Some of the cycles I mentioned, for example, the real estate cycle and the private sector capex cycle, these are typically long duration cycles. You have long duration downturns from which we are coming out, like I mentioned. And typically, once the upturn begins, you have long duration upturns as well. Similarly, the banking cycle, again, is also a long duration one. So I think we are still in the second year of the banking upturn, and you still got, I think, at least 2-3 years good to go. And then you have other cycles which I mentioned. Some of them could be shorter in nature also, and therefore, the call will be taken accordingly. So I think the beauty of this product is that you get a portfolio of companies which are looking good from a business upcycle perspective, and you avoid the companies which are in a down cycle or about to enter a down cycle. And you're constantly evaluating the positioning of these various businesses and the companies in the various cycles. And 2 years later, you may find a different set of cycles which are looking better. And accordingly, realignment of portfolios can be done. So you get a dynamic allocation of stocks across cycles which are looking good. And it's a very agile portfolio. And therefore, I think it's a good product.
Just one follow-up question. The market cycle often precedes the fundamental cycles. We very often see the markets peaking out, hitting a high, before things start turning south from the real economy point of view. So in that context, if many of these cycles are in their second year, do you not get a sense that perhaps markets today have already priced in a lot of the good news?
So, I think in terms of valuations and market cycle and business cycles, one has to keep, the perspective clear. I think this particular product is going to focus on timing of the business cycles and building a portfolio of business cycles which are looking good. And it'll be a blend of both secular stocks, which are in the midst of an upcycle, as well as cyclical stocks, which are on the cusp of another business upcycle. So the focus is on timing of the business cycles and not timing the market. So this is a product which is fairly independent of the market cycle, and it's fairly independent of the economic cycle. Sometimes the economy grows at above par, sometimes below par. So we are focusing on business cycles which happen at a subsector level. And therefore, I would say timing from a market cycle perspective is not an issue with this product.
Right. And, just wanted to understand what would the average duration of holding in a fund like yours be? I mean, how quickly do you decide whether one should be in a certain cycle or one shouldn't? And at the same time, a lot of people say that the leader of a down cycle is still better than a laggard in an up cycle. I mean, what are your thoughts in that?
Sure. So, like I said, the duration of these upturns vary. It could be as short as 1 year to as long as 5 to 7 years, and some will fall somewhere in the middle. So we have a process in place. Our analyst team is very strong, very robust, with WorkX over 20 years, and they've tracked these sectors and cycles over the last 2 decades. So I think there's a strong team which is going to give quality inputs in terms of positioning of the cycles. And in terms of duration, like I said, there's no fixed time frame. It's an entire range ranging from 1 to 5 years. And the focus has to be in, focusing on the parameters like volume growth, pricing power, competition level, bargaining power in the sector, and keep determining regularly as to what stage of the business cycle that subsector is in, and keep positioning companies accordingly in terms of stock picking in the portfolio. As far as down cycle is concerned, like I said, the fund's mandate is to avoid companies in a down cycle. So whether it's a leader or laggard, you won't find such names in the portfolio, irrespective of the trend of outperformance in the past. The focus will remain singularly on companies and businesses in which there is high visibility in terms of the upcycle continuing or the inflection point coming.
Interesting, NFO. Thank you very much, Rahul, for joining us and explaining that, and all the very best to you. Need to take a short break, but as always, when we return, we'll get you a check on what dealing rooms are saying in our segment, D Street Chatter.